Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to take a 30-year look at Amazon. We're going to look at Amazon from the IPO to current period. That's going to cover the IPO period. It's going to cover the dot-com bust and the crash. It's going to cover the lost decade after the crash, and it's going to bring us to current period. That's what we're going to go through. Then we're going to forecast Amazon out for a decade, see what we think we can earn if we bought the stock today. Ready? Let's get to work. All right, before we dive into Amazon, and I want to remind you all to read the 10Ks. I did a review last year of Amazon where I went through the 10K in detail. They definitely focus on cash generation. Go watch that video. This video, we're going to focus on just the historical financials. We're going to go a long way back to 27 years, back to 1994. They IPO'd in 97, and then they crashed in the lost decade. So we're going to review all that. Before we do, I want to give a couple shout outs to some great subscribers and comments to people who are subscribing to this channel or commenting down below. Derek Chen said, very good analysis. This was on my last video for Microsoft. I got RK said, back to basics. Thank you, Cameron, for refocusing on the basics amidst all the hype and the FUD. Really appreciate it, guys. Thank you. A last one, David Johnson, awesome analysis. Thanks so much for the comments. I really appreciate all the support on the channel, and I really appreciate all the support over at cashflowinvestingpro.com, my website where I have both a cash flow club where I release a lot more analysis than I can cover in a weekly YouTube channel. But I do this analysis for a whole host of stocks, and I publish it there in that community for the membership club. And if you just want to learn how to do financial analysis on your own, I do teach a course that I'll give you all the materials, and you'll see what we're going to go through. I'll give them all to you and let you learn how to do it and teach yourself to do it for the rest of your life. Let's review the 5 key attributes that we use on this channel to value all of our securities. Number 1, top line revenue growth. It must be there. Number 2, EBITDA growth, earnings level growth. It could be operating income, it could be EBIT. We use EBITDA, but you want that number to be growing. Strong free cash flow. Absolutely, this is a cash flow channel. Low debt. We want less than 3 times debt to EBITDA, and you want a well-priced stock. You don't want to pay too much for a good thing, but great companies rarely become too cheap. So you want to find a reasonable price that you can buy a cash generating machine and hold it for a long time. That's what we do here. We value stocks and we look at them over a 10-year period of time to figure out if they're well priced. And we're going to go through that with Amazon right now. All right, let's dive right into Amazon. We're going to begin with the first period that we're going to review, the IPO. And the IPO happened here in 1997. They IPO'd at $1.50 a share kind of mid-year. I'm pulling the year-end, fiscal year-end, December. So by the time December came around from May when they IPO'd, it's already gone up 500% to $5 from an IPO of $1.50. It then proceeds to continue to grow from that $1.50 IPO range, even though it says $5 here because of December is when I benchmarked the year. But then it moved to $53 and then $76 a share. Very fast. That is, more than 10 times. I think when I looked at it from $1.50 to $76 is a 50x on your money in 3 years from its IPO. So that was very robust acceleration as it launched into the euphoric markets that were the 1999-2000 era period. And when I look at cash flow from the business, you can see they got negative cash flow from operations on the year. They're borrowing money, and their valuation is at $76 a share. Let's zip down to the revenue section of the report, and I just want to highlight the same period of time. So this is the IPO, right? Revenue's growing, awesome. They got $148 million of revenue the year they IPO'd. EBITDA was negative, losses were growing. So this looks very similar to a lot of the businesses that we see currently in this market. You've got accelerating top line, you've got accelerating losses, and you have a monster value. Here it's at 1.4 billion. It sounds like nothing in these markets. And then it grew very quickly to about $17 billion. And then finally at the peak, when it absolutely hit the peak of the market, It's a $27 billion market cap. That was the crash period. So let's take a look at the crash and see what happened. At the crash, at $27 billion of enterprise value, what share price was that? Well, that was about $76 a share. So it went from $5 to 76, 50x, hit this, and then it absolutely collapsed, right? So the crash went from $76 a share to $15 a share. In fact, it kept falling to 10. That's a monster drop. That's almost a 85% drop in share price and value that you bought in. Had you bought the shares at the peak. So what happens is we now transition into a period I'm calling the lost decade, where it's a period of time when you have a $76 price target, which is an extreme valuation for a company that's growing revenue with negative earnings, that then falls because the market itself is just everyone's leaving the market. The crash wiped out many people, and with the scary nature of that collapse, people were selling stocks indiscriminately. All they wanted to do was get into cash, and so it really didn't matter if a stock was growing, if it produced cash flow, any of that stuff. All they wanted to do was just get their cash out, and they were selling stocks indiscriminately. Amazon was one for a long time. It took it almost 10 years. It's 9 years to get back to where it once was at $92 a share. If we look in terms of years, 99 to 2007. During this period, however, the cash flow of the business goes from negative to positive 1.4 billion. So it really does show the difference between the mob of the market, which is kind of like a group of high school kids that are just following the crowd, and the underlying operations of a business, which is churning away as Jeff Bezos is building what is going to become a behemoth. The market clearly ignoring the performance as they turn around and generate a whole lot more cash. The market continues to hemorrhage cash. We saw this with Microsoft as well. You see it with a lot of the tech companies in the dot-com era bust, when everyone just gets so burnt and they just leave the sector, and that visceral reaction of, I just lost 85% of my money, means that I don't want to touch the stock for a long time. And it becomes unloved. And that's the mob mentality of the market, and it absolutely does happen. And we are currently at a stage in the market where there are a lot of companies that have growing revenue, negative or increasing losses, and trade at very high multiples. And at some point, that could reverse, much like we've seen in the past. And when that does happen, you can lose 80% of your investment. And if you choose to hang on to it, you have to hang on to it for almost a decade before you ever break even. And that's very hard to stomach. I'm not sure lots of people who bought the IPO at Amazon held on to current day. If they did, good for them. But if they didn't, they would have most likely had a significant loss. Let's take a look at what this looked like on revenue for the crash. So the crash happened in 2000, and we go to 07. So here's the period of time when it crashes. Its peaked value, this is enterprise value, by the way, $27 billion on negative EBITDA. So it's still losing money. It then collapses to an enterprise value of $5.5 billion. So significantly less, from 27 to 5. But earnings and revenue has tripled to $3 billion, and they break even at this point. And they're the cheapest they've ever been in terms of enterprise value. Then what happens? They continue to grow to $14 billion. So at the end of this decade, they have grown their revenue 10 times, and the market has just now broken even. That's what happens when the market gets stung, and it's the difference between rational investing and the mob mentality. If you're buying based on expected growth, then you're subject to this type of brutality. If you wait and you look at how the company's performing, you have many years here where the company's growing revenue, is profitable, has strong free cash, has low debt, all the hallmarks that we look for, and you could have bought the company for a reasonable price, still expensive, but a reasonable price. The low point here is 28 times EBITDA before all of the other growth in the subsequent decade. Now that's gonna bring us to the current period. Let's take a look at the current period of Amazon and how it's performing. So if I then come from, say, 2009, $24 billion, $34 billion. I bring it all the way to present day, last filing of the annual 10K, $386 billion of revenue. Is absolute monster company. And the EBITDA has grown from $1.3 billion to $48 billion every single year. Positive growth. That's fantastic. Lastly, if we just go all the way down and look at the last decade, this is the average of the last decade. 45% annualized growth rate for EBITDA, 26% annualized growth rate for revenue. So definitely, the stock is definitely continuing to grow. And the lesson here is you get overstretched when the market is euphoric. The sting of the initial drop prevents people from buying it for a long time, as they have to kind of forget that memory. And in that period of time, A, it's a decade, it can be a long time. B, there's a lot of great value that you can pick up if you're prepared with cash, you have the ability to wait, and you're looking at the underlying numbers. But this is 27 years of Amazon. I'll go through a little bit more, and we'll cover the 5 key attributes. We'll summarize them. Let's keep going and look at enterprise value and some of the market multiples that Amazon traded at. So again, just to recap, and I'll lock this top so you can see it as I go through. But I'll recap revenue for you in one giant screen. So it starts off at zero, right? They IPO $148 billion. They grow to the crash, call it $2.7 billion of revenue. And then it continues to grow. The lost decade, call it $14 billion of revenue. That covered the lost decade period. And then to current, we bring that up current, it comes all the way to $386 billion. Continued growth every single year for 28 years. That's remarkable. I put Jeff Bezos up there as one of the greatest entrepreneurs of all time. What he built is absolutely incredible. Same thing for the EBITDA. You see here large negative periods where they're investing in themselves. It would have taken a really insightful analyst to be able to pull apart how they're spending their cash and realize that they were generating profit with some of the investments they were making if you add those back. But I think the point here is it gets over its skis, collapses, and there's a beautiful period here where you can buy a wonderful company at a reasonable price with a good track record of positive earnings, positive growth. You don't have to take the risk of buying something that's negative here, because many companies during the dot-com era did not turn around. But if we continue over to current day, enterprise value $1.7 trillion and an EBITDA market multiple of 35 times. So still a strong market multiple even after so many years. I will say that this market multiple has remained elevated over its history. And if I look at the last, say, 10 years or so, it's gone from roughly 45 times EBITDA down to about a 35, maybe in the last 20s, high 20s. So it seems like every decade or so, the market multiple drops about 10 times. So you go from 40s to maybe 30. So we're going to assume in the next decade, it's going to go down to 20 as this business matures and growth slows. The market multiple we pay for that growth is going to come down. But we'll come to that in a second. Lastly, debt to EBITDA, the leverage ratio that we use is 1.2. So what does that mean? That means they have debt equal to roughly 1.2 years of earnings, which is excellent. So that means they can pay off all their debt with 1 year of operations, which is what we want to see, because ultimately we are equity investors. We are the last in the capital stack. If the company was to ever go to bankruptcy, all the creditors, all the people that the business owed money to would go to the judge and say, hey, I want my money back that I put in the stock. Us as equity owners, we are the very last in line to ever get paid in any kind of bankruptcy settlement. So you always want to make sure the businesses you buy have very little debt. That means that your equity is almost bond-like. It's almost like you bought the bond and you have a senior, like a mortgage on a house, like you have a senior claim on that asset, but you get the return of an equity owner. That's what we want to see. And I like this position. 35 times is a reasonable price for a company that's been accelerating like this so fast. We're going to see what that looks like in a forecast and if it's reasonable for us to buy it. Okay, just like I did before with the revenue and EBITDA and enterprise value, let's just take a quick look at free cash flow over the years and just see how that has performed. Again, in the period of time when we're coming up to the IPO, large investments, kind of negative cash flow from operations. You get the collapse where they're still burning money. And the market resets. You get the lost decade where they continue to grow, but nobody wants to buy the stock because everyone's burnt from the industry. And you get the current period where they're basically just cranking out cash for a long, long period of time, all the way up to $66 billion of free cash flow from operations from, say, the 3.2 billion where we start emerging from that lost decade. You come to current period, they go from 3.2 to $66 billion of cash flow from operations, which is tremendous. Now, I will say one thing I like to look at is cash flow from operations, and let me hide this so you can see it properly. So cash flow from operations is here. CAPEX, that's the money they have to put back in the business, back into AWS, into the airline system that they're trying to invent, into the online infrastructure, the website, all that stuff. That sits in CAPEX. And what I like to do is look at the difference between these two. Because this is saying when they operate their business, in the bank, they produced $66 billion of cash. They peel off, in this case, $40 billion to reinvest in the business, and they're left with $26 billion of cash that is just a byproduct of running a beautiful business. They have almost no debt, so there's no debt to pay. That means this $26 billion belongs to you and I, the equity owners. This is what we're buying when we buy Amazon. You can either A, follow the mob and buy because you believe the price is going to be higher tomorrow, or B, you can follow a strategy like mine that says it's producing $26 billion of free cash flow. I think that's going to continue or grow, what have you, and I'm going to price the stock off that cash flow. And if it doesn't pencil out, I don't buy it. But if it does pencil out, I can put my money against it, and I know with some degree of certainty, at least I have a framework, that it's a real number, it's audited, it's been checked, and if the stock price falls, I have something to hang my hat on it of why I bought the stock in the first place. I think the biggest thing that people do, they get ahead of themselves. They buy a stock because everyone else is buying its stock. They have no underlying thesis for where the stock's going to go in the future, and when they get in trouble, they sell it. And that's how you end up losing money. Although you can lose money in this strategy, at least you have an underlying thesis for why you bought it in the first place. So you're buying this $26 billion, 25. If I look at the diluted shares outstanding, they have 500 million shares, 503 million shares outstanding. I divide these two numbers and I get $49 per share. That is the per share percentage or free cash flow that I get for every share I buy, $49. Well, the price, $3,256 as of December of 2020. So it's getting old. I'm expecting another 10K to be released at the end of, actually another month or so, we'll go through it. But if I divide the cash that produces by the price, it's a yield of 1.5, which is a very low yield. It is, in this channel, I like to find things that are 5 to 10% of free cash flow yield. This thing is yielding low because it's growing and people are paying for growth, but it's positive. I'll take that. And it has a long, long track record of producing free cash flow, which is amazing. I'll also comment in my last video when I reviewed Amazon for the first time, I did go through the 10K and some of the presentations that they walk through for investors. They do a great job at focusing on free cash flow. In fact, it's one of the very first slides that they put in their investor deck. And when you're reading presentations from a company, keep in mind that these are sales documents. If it's not the SEC filed 10K, it's a sales document. If it has color and images, it's a sales document. They want to sell investors to get the money in so they can continue to run. What a lot of companies do is they don't talk about free cash flow. They'll talk about revenue, or they'll talk about customers, they'll talk about total addressable market, the TAM. We want companies that talk about free cash flow. Amazon does a great job, and I think it's slide number 1 or 2 or 3 on their presentation. It's the very top of the deck, and it talks about free cash flow. So good for them for focusing on that's what we want to do, and I think it bears out of their financial results that you can see behind me. Okay, now we just went through IPO, the crash, the lost decade and current period, enterprise to value to EBITDA ratio, and how the market left, the ratio collapsed, and there was this long period of time that the business continued to grow and to perform. I'm going to summarize that for you in one quick chart. Behind me, you've got EBITDA as the bar. The blue bar is the EBITDA, annual EBITDA of the business. And the orange line is the enterprise value to EBITDA, the ratio. So you can see it IPOs in 2007. It IPOs in 1997. And earnings are negative, so the EBITDA market multiple is negative. So I just cut it off to make it simpler. So, and EBITDA is extremely low. So it trades at a very high price. It ends up running up to the .com crash at 70, this 120 times EBITDA. But that's essentially the peak price that we saw of $76 per share. That's about 160 times EBITDA at that point because EBITDA is negative, flips positive, and the EBITDA is so small, it produces a very high market multiple. And what happens is that crash, when you see the stock price falling from $76 to $10 as earnings grow, you'll notice that earnings, although very small here, continue to grow and be positive. The market multiple comes down because the whole market is losing cash as everyone's running away from the sector entirely. So there's two aspects to any stock purchase, right? It's the cash flow you're paying, and it's the multiple, the number of times that you're paying for that cash. And you can see here that collapses and becomes very, very cheap. As earnings continue to grow, as people leave the sector, it crashes to the low point, and then kind of hovers around this period, slowly going down. So you've got if I had to break it up into sections, you've got the IPO period and its crash. You've got the lost decade that we covered here where earnings continue to grow, and all that did is the multiple just kept coming down as earnings continue to grow. And then you have the kind of current period where Amazon really gets its legs underneath it, continues to grow, and the market multiple comes down slowly over time from that 50x to about 30 where it's now sitting at. And I think in the next decade, it'll come down even further to 20. So that's a nice little summary to show you what happens, the difference between kind of how a business itself continues to grow revenue, grow earnings, but the market can be disconnected from that growth and just not want to buy it. And that's when this channel comes into practice. Okay, so we've done the review now of 27 years of history. We've covered the IPO, we've covered the crash, the lost decade, and the current period. And what's really, really interesting about this stock is it crests in the euphoria of the .com, got way over its skis, and it's very similar to a lot of stocks we see today in this market. You have growing top-line revenue, but you also have growing losses. And you have a market multiple that's based on expecting the price tomorrow to be higher than today. That's it. And then when the market finally realized that cash is important, when the mob left the market, the equity market, for safety, the price dropped 80%. I think it was from $75 to there it is, $76 to $10 at the low. And if that's you in your portfolio, it's going to be very, very hard for you to stick it out and see what happens. So the best thing, in my opinion, is to buy companies at a reasonable price when they have a track record of performance, when they generate cash. And you could have done that with Amazon any period in this late 2000s era when they're trading at a low of $39 relative and in a market multiple of, say, 28 times EBITDA. At the low point in 2006. That would have been an amazing time to buy it. You would have many, many years of profitable track record to measure it on. So it's just an example. Obviously, this is speculation because you're going back in time and kind of cherry picking the best point. But my point here is that you can absolutely use historical patterns to find what is profitable, when it's profitable to buy stock, and how you want to hold on to it. And I cover that at my website, cashflowinvestingpro.com. Check it out. I'm going to release the one-pager on Amazon where I publish all this material. I give a forecast for it. I give a summary, and you can check out all the detail at cashflowinvestingpro.com. Okay, let's forecast the business now. We're going to forecast on two methods. We're going to use the EBITDA market multiple method, and we're going to use a free cash flow method to come up with what we believe the future price is of Amazon 10 years from now. Let's do it. Okay, behind me is the EBITDA forecast. Now, we have a $60 billion EBITDA number for 2021. They've already printed 3/4 of this, so I'm looking at the 3/4 plus an extra quarter to get to a $60 billion number. That's about a 25% year-over-year growth from 2000 to 2021. They've already booked 3/4 of this, so I think it's going to be very, very close to that number. I then take that growth rate and the growth rate that they've experienced previously, and I reduce it over time to be conservative. I hope that they can beat this number, but as they get bigger, it's going to be harder and harder for them to grow their earnings. Earnings growth is going to slow, so I bring it all the way down to an average of 10% kind of at the end of the period. But what that does do is it produces a very large number of $184 billion of annual EBITDA out a decade. This is 2030 time. And at that time, I'm going to play a 20 times market multiple to it. Why? A, growth is slowing. You go from 25 to 10. So you got a business that's maturing, does not need a huge multiple. Second, as we saw earlier, market multiples come down over time. And if I highlight for you this section here from say 50, from like this high of 50 here, that was a low, but it quickly jumped back to 40, 50, which is a current 27 to 50. This is about a 10 turns of EBITDA drop over a decade. Well, as they mature, I'm expecting another 10 or so point drop. And what does this yield? So you've got a 20x on $184 billion of EBITDA. That's a $1.4 trillion market cap of the business, less some debt they have, plus some cash. Excuse me, strike. Yeah, that's right. And then you've got a market cap of $3.5 trillion. I leave shares the same because I'm assuming they're going to dividend all the money out. It's an assumption, just a clean cleansing assumption. But they're not going to do any share buybacks. And I divide these two, and I get $6,982 per share as a long-term price target for Amazon at the EBITDA market multiple approach. I get a lot of questions about EBITDA and why I use it, and Buffett and Charlie Munger say it's trash, and I agree with you. If you're trying to make EBITDA into cash flow, it's a garbage statistic, and that's not why I use it. It's not cash flow. I use it because the market, the finance market, private equity, investment banks, even corporations, when they acquire other businesses, they typically state the acquisition as a multiple of EBITDA. So even though it's an inferior measure of cash flow, I'm not using it here as a measure of cash flow. I'm using it here as a measure of market value, and it's relative. So it's okay to use historical period numbers, ratios, to present day because it's all going to be relative. And with investment banks, with private equity groups, with corporations, publicly stating how much they're acquiring for businesses based on an EBITDA number, I can use that market multiple to get an estimate of what Amazon might be. That's why we use it. But I pair it with a free cash flow analysis, which we're going to go through now as a counterweight. Let's check it out. Okay, here's our free cash flow forecast for Amazon. Now I'm picking up with the same growth rate that I assumed last for 2021, 25%. And I take 2020 free cash flow per share, the $43 a share that I showed you before, and I grow it to $61. And I follow the same EBITDA growth rate until I get a free cash flow of $189 per share. Why? Because free cash flow should grow in line with EBITDA. They don't have much debt. So as EBITDA grows, free cash flow should grow commensurate. We're not buying back any other shares, so it's a pretty one-to-one ratio. When I get out this year, I'm going to give a 2.5% free cash flow yield to that. That's based on historical patterns, slightly higher yield than current 1.5 because it would have matured, it would slow down. And I get $7,575 as a long-term price target based on a free cash flow method. All right, now we have two methods to value Amazon. One, free cash flow, $7,500 roughly. EBITDA market multiple, 6,982. All right, I'll have the two, and I'll get a price target of $7,300. Let's put that into our IRR and see what we get. Here's our IRR calculation. What we're going to do is we're going to take the free cash flow that we generated over the decade. That's cash flow that belongs to us because we legally own a percentage of Amazon. This is a percentage of the cash flow that I should receive. Whether it dividends out or they buy back stock with it or whatever they want to do, it's still my ownership. It's still part of my investment. I've been buying right now as much stock as I want at $3,240. In 10 years, I think I'm going to sell this same one shares of Amazon at $7,279. Plus, I get this stream of cash flow. When I put all that together and I look at it on an IRR basis, that's a 12% annualized IRR. So every year, that means every year, I'm expecting to make 12% on my money if I bought Amazon today at the price of $3,240 a share. Now that can move. If the price comes down or goes up, let me give you a distribution chart that over time, if you come back to this video and rewind it and say, hey, is it a buy now or later? What do you want to do? This will give you an idea. So as the price of Amazon falls, if for some reason the market collapses, like we saw earlier in the .com crash, and people just run away from the market, I don't know, let's say the Fed stopping printing $128 billion a month of dollars, that might cause a lot of people to stop running into the stock market. If the price falls, I think it becomes extremely attractive at this valuation. Any higher, I would not be a buyer. I think it's way too much risk. There's still a lot of growth in this forecast, so I would hold off at a higher price. But technically speaking, 12% is higher than 10%. 10% is our benchmark for the S&P 500, which is what we are trying to beat. So I'm going to give this a good rating. I'm giving it a 12% IRR because it's higher than the 10% on average the S&P 500 will generate. Now, I do think there's a lot of risk in that number. The growth rate that they have to achieve is still very strong, and they're having increased competition from people like Walmart and others that are figuring out this game. So I would like to see Amazon a little cheaper, but like I said in our 5 key attributes, well-priced means market beating. This is expected to beat the market, so it's well-priced. Let's review the 5 key attributes and summarize Amazon. So number 1, top-line revenue growth. It's there. It's growing very, very strongly. Number 2, EBITDA growth is growing as well. Strong free cash flow, absolutely, for a long, long time and growing. Low debt, yes. Well-priced, yes, it is. Because it's yielding an expected return of greater than 10% for us, that means it's well-priced. So it gets a good rating. It meets all the 5 criteria. I would like to see it a little cheaper, but if the market were to crash for some reason, this is definitely a stock I would look to for safety. And if it comes down in price, I'd be a buyer. I want to remind you that I've got a course at Cash Flow Investing Pro, and what this is going to do is it's going to provide the template to you that I just went through. It's going to teach you how to read 10Ks, which you should be reading on all of your investments. It's going to tell you how to pull out the particular pieces of information you need to assemble an EBITDA number and to build a free cash flow forecast. It's then going to walk you through how to build a focused portfolio. A focused portfolio is a portfolio of about 20 stocks that are the best of the best that you believe will perform over the next decade, and you hold those and you have your review and you look at it every single year when you read the 10K. Now that is how to build a focused portfolio. I teach that course. It's about 3 hours of content, slides. You get all the material. Check it out on my website, cashflowinvestingpro.com. I also produce a monthly club called the Cash Flow Club, where I release one-pagers. This happens to be 2 pages because there's 27 years of data, but typically it's a decade on each company. And I go through, do they make cash? How much debt do they have? Are they growing? And I say, is it reasonable for a long-term investor to expect a return on this stock? A lot of discussion there. Please, please, please check it out. If you like this video, hit the like button. Throw me a comment down below. Tell me what you would like to see. I'm happy to take recommendations, what you thought of this video, and hit that subscribe button. I'm trying to get to 50,000 subscribers. I could use your support. Thank you very much for the time, all the questions and comments. I greatly appreciate it. Hope you enjoyed my review of Amazon, and I'll see you next week. Take care. Bye-bye.